week, February IIP numbers come in below expectations, while January's output figures are revised downwards by 84%. Find out how this impacts your investments. Infosys FY13 guidance disappoints the market. We'll tell you what this means for your IT stocks. And Amrish Baliga picks L&T and IRB Infra as smart investment options for you. We'll find out why. Welcome to All About Stocks. You're watching ET Now. We're at the beginning of another earnings season. This means the newspapers are going to be full of information about net profits, margins and dollar earnings. This is where you learn what that means and how it impacts your stock portfolio. Remember, the recommendations you hear on this show are for a long-term horizon of 2 to 3 years. There's an email ID at the bottom of your screen where you can write to us and send us any questions you might have about your stocks portfolio or about any particular investment you have. There's also a Facebook page on which you can reach us. So before we go on to tell you what stocks you should be investing in this week, my colleague Navneet is here with the latest on the markets. Navneet.
Well, not a great week for the markets. If you look at the indices, Nifty and Sensex, both were down by over 2% for the week, and similar is the case with the broader markets. The mid-cap index was too down by about 2%, but small cap was down by only 0.5%, and it was the defensive which actually played out during the week. So you had counters like HUL, Rinvaxi, ITC, all these counters were up during the week in the range of 4 to 6%, and it was the entire IT pack which came under pressure after Infosys came out with a number. So among the losers, it was Infosys which was down by about 16% for the week, followed by TCS about 10%, also JP Associates. And important numbers came out during the week, the IP numbers for the month of February, which came below the market expectations of 7%. So you had February IP growth number coming in approximately at 4.1% on year-on-year basis. And if you look at the mining activity, which actually picked up in the month of February, followed by electricity, which lost steam, and manufacturing, there was an uptick growth witnessed there as well.
Right, Navneet, and like always, Infosys was the first to announce its results this week. Take us through those numbers. How did the market react?
Well, you had the earnings season which started on Friday with Infosys declaring its numbers. The numbers were below what the markets were estimating. The revenues for the company was down by about 4%, and you also had the profit figure which was down by about over 2%. Well, the biggest disappointment in the numbers was the guidance given by the company for FY13, which was below the guidance which is actually set by NASSCOM for the entire IT sector of about 14% for FY13. But you had Infosys which gave its FY13 guidance of almost 8 to 10%. That is the revenue guidance, and usually NASSCOM meets its target every year. So you had Infosys which gave its guidance below that, and the major blow also came after the brokerages which came out with its report where their numbers didn't meet up with the numbers declared by Infosys, and you had the stock which reacted pretty negatively post the numbers. So the Infosys counter, which was down by about 16% for the week, on Friday itself it lost almost over 12%.
Thank you, Navneet, for all of that information. Joining us now in the studio to help us understand all what Navneet just told us is Amrish Baliga, the COO of Way2Wealth. Amrish, thank you so much for joining us on this show. It's a pleasure to have you. Now, before we talk about the Infosys results, which we're going to get to in a little while, I want to talk about those IIP numbers. This month's number was disappointing. The revision on January's number was even more disappointing. There are a lot of analysts who are now saying this looks like the beginning of a slowdown. Could you explain to us what's going on exactly?
I mean, we also don't know what's going on, because if the numbers can be revised by that huge difference, I mean, they talked about 6 odd in January and now they're revising to 1 odd. I mean, I really don't know as to how much to trust these figures. Yes, there's a slowdown, but I mean, changing figures like this is something which is just not acceptable. I don't know how the international investors will read this.
The finance minister came out on Thursday evening and said, you know, the RBI is going to have to take some steps now, and that's the only way we can revive growth in the country. So this is the two questions here. One, if, like everybody else, if the RBI feels that this number might be revised next month, then it might not want to react.
Right.
But in your opinion, what do you expect the RBI to do next week?
I mean, first of all, this statement clearly shows its helplessness. And yes, I think RBI will have to act, but I don't know whether RBI will act on April 17th. Even if they act, may not be more than 25 basis points. But yes, I think if they do that, there will be some sort of a trigger. But if you're talking of the rest of the year, going ahead, yes, I mean, we clearly expect a 75 to 100 basis points cut in the repo rate. And that should be a good trigger enough going ahead.
If we're expecting those rate cuts to come in, then we need to talk about banking, auto, and real estate. Where do you see these three sectors moving towards the end of the year?
Banking sector, if you're talking of the rest of the year, yes, I do see banking and auto performing. Realty could see some upward movement because of the rate cuts, but may not really sustain because the underlying, which is the property prices, especially in Delhi, NCR, and Mumbai, I mean, we still expect them to correct because if you really look at the demand at the ground level, it is not there. And once that happens, you'll actually see the stocks even correcting further. As far as the banks are concerned, we are positive on the private sector banks. And I mean, even from these levels, I mean, although we see some correction, if you're talking the next 1.5 to 2 months, we see some correction in banks. But then overall, I think it should give you a return of about 20-22%. Autos, yes, selectively we are quite positive. I mean, I would still look at a Maruti, but on a correction. Tata Motors, possibly at levels of closer to about 250, 260, I think one could look at that. Ashok Leyland, even at the current levels, is looking good. So I think these are the stocks to be in, but just wait for a small correction.
I want to bring you back to banking. Ideally, the big banks would have made sense to pick it up towards the end of last year, November, December, when we saw them being available at very good valuations. For those of our viewers who didn't buy banking stocks back then, do you think it makes sense to pick up right now, before the rate cut actually turns and before the end of this year? Could you name a couple of stocks that you think make sense at these valuations?
No, I mean, when you're thinking of buying now, I would say possibly wait for the monetary policy because the sort of run-up which we've seen in the past couple of days is taking into account that there will be a 25 basis points cut. If it happens, well and good. But if it doesn't happen, look at the flip side. You could actually see a correction in the banking space, at least for the next fortnight or so. Utilize that opportunity and buy.
All right, so this is interesting advice. Keep an eye on the RBI next week during that meet, and if there isn't a rate cut, then we'll see banking correct a little bit. That's a good opportunity for us as retail investors to pick up banking stocks for the long term. Let's talk about Infosys. We know the numbers came out on Friday. The guidance disappointed the market. How are you reading into this right now? For the rest of the year, where do you see Infosys going?
In just one sentence, I could say that possibly the best is behind them as far as Infosys is concerned, and IT sector overall. I mean, if you're talking of the larger players, because with the sort of growth prospect which is there, I mean, at least the foreseeable future which the Infosys management has guided, for 8 to 10% sort of a growth, why should you pay premium valuations which the market has been giving them for the last 10 years? So this actually you'll see a decent correction even from these levels. In fact, in the next couple of weeks, we could see Infosys possibly at levels of closer to about 2,200.
2,200 on Infosys. This is interesting, Amish. I want to take some time to talk to you about this. We have a lot of retail investors who feel the need to have an Infosys or a Wipro or a TCS in their portfolios because they think it's a strong, big company. It's not going to go anywhere. But you said you barely see it giving us 8 to 10% in the long term. Tell us, do you think it makes sense to have these stocks in our portfolio right now, or are there better options there other than the IT pack?
There are two reasons why you generally pick up a particular stock in your portfolio. One is the security aspect, and the second one is the returns. Yes, Infosys will possibly give you that security, but may not really give you the returns if you're talking of at least the foreseeable next 1 or 2 years. I think the way to look at it is would be compared with Hindustan Unilever, which was the darling of the market, which gave you extremely good returns in the 80s and 90s. But what happened between 2001 and 2010? I think something similar could happen for Infosys, and that's the reason I said I think the best is behind them.
So for those viewers right now who are holding Infosys stocks or maybe even TCS in their portfolio, what would be your recommendation?
I think they should book out and possibly look for some other stocks which could possibly give them better returns, but at the same time would actually give them a decent amount of security.
All right, so look for opportunities to book out of Infosys and TCS. Amish, of the opinion that it's not going to give you the kind of run-up that you would expect from a stock, even though it does offer you a decent amount of security. All right, let's move on now to our portfolio segment. Now, every week we look at the portfolio of one lucky viewer and tell him how he should be tweaking his portfolio to make the most of the market. This week, Suraj from Bangalore has written in. He tells us he has 120 shares of Wipro, which he bought at 376, 1,000 shares of Ashok Leyland he bought at 31 rupees, and 620 shares of JP Associates, which he bought at 86. Now, he's planning to hold these shares for the long term. He also wants to invest more, and he wants you to tell him how he can build his portfolio. You did say Ashok Leyland is a good buy,
right.
But when you look at these three stocks, would you like him to tweak something around?
Like I said, I think he should exit Wipro even before the results are out. Because again, if the results are in line with what we have seen in Infosys, which is possible because Wipro has gone through the restructuring, so don't really expect any great shakes in this quarter.
And he has made about 30 rupees on each share, so he has a profit there.
So I think he should book out of Wipro. JP Associates, again, we saw a recent high closer to 86, 87 levels. And again, the triggers would be, again, there's new cement plant, inauguration of the expressway. Because of these triggers, you could see some more bump up. But I think, closer to about 90, 94 levels, I think you should exit JP.
All right, Suraj, you need to be booking out of Wipro and holding on to the other two stocks. Coming up after the break, we'll talk about L&T, which is Amrish's first recommendation for us this week. We'll find out why we should be investing in it now.